So the subject of today's video is going to be more or less talking a little bit about how you can screen and fact check your personal financial advisors, your insurance agents, your mortgage brokers to ensure that you're getting good quality advice from them. It's incredibly important that you do this because having bad financial advice can have really dire effects. It can be devastating for your personal finance, for your savings, and so it's really important that you do take some steps to ensure that you're getting quality advice. And so that's sort of a breakdown of this video. Realistically, if you're going to an advisor to get advice, you're not going to be able to put the time in to fully know whether or not they're providing you with the best information. Otherwise, you would just manage your own finances. Because the absolute best way to protect yourself is to be informed. So realistically, you're not going to put in the time, if you're going to an advisor, to become your own advisor. You're not going to necessarily go to school, figure all these things out. It's understandable. But what you can do to protect yourself is at least know a little bit about each area that you're dealing with when it comes to personal finance, so that you can fact check this individual on that specific area. And basically what I'm going to break down is for insurance agents, investment advisor, and a mortgage broker, what specific piece of information you should know so that you can pretty quickly know whether or not this person knows what they're talking about, whether or not they have your best interest at heart, and sort of just as a quick way to indicate whether or not you're getting the best financial advice. Again, the absolute best way to protect yourself is know as much knowledge as possible. The more knowledge you know, the better you're going to be protected, but you probably don't have time to go out and learn everything else. That's why you're going to an advisor. So we'll break down the sort of three main areas, starting with insurance. The major thing with insurance is whenever you're taking on a piece of insurance, it should map to a specific risk. So what does that mean? Well, what you want to do is do sort of a quick analysis. When you pass away, what happens to your family and the people you care about around you? And the reason you take on insurance is to cover those risks. So in an example, let's say that you have a wife and children. If you were to pass away, and your wife depended on your income to pay the mortgage payments for a mortgage that you have for, say, another 15 years. You have $200,000 on that mortgage. Well, that would be a risk that you would then cover with insurance. You would cover that with insurance because when you pass away, your wife would not be able to make those payments. So whenever you're getting insurance, it should map to a specific risk. In this case, you would get $200,000 worth of temporary insurance, 15-year term, because you want that insurance to cover you for that period of time. It covers that risk. If you don't pass away, fantastic. It's no longer a worry. You've paid off your mortgage. If you do, that risk is covered. Your family is safe. That's the idea behind insurance. You really need to be aware or stay away from sort of a cookie cutter approach. You'll sometimes hear people say, oh, you need 10% of your income to go into insurance, 5%, 15%. No. Insurance should be specific risk covered by specific insurance for the amount of time that you have that risk. So in the example I said before, you have that mortgage for 15 years. You need the insurance for 15 years. The mortgage was for $150,000 or $200,000 remaining. $200,000 of term. Specific risk, specific time. Avoid cookie cutter approaches and only get insurance for as long as you need it. The reason term is more beneficial than things like whole life is because it's going to be less expensive, much less expensive. So that's sort of the big thing with insurance. Make sure your insurance agent is mapping each piece of insurance that you're getting to a specific risk that will happen if you were to pass away to your family. That's sort of how you sort of ensure that you're getting at least quality advice from an insurance agent or fairly quality advice. Investment advisors, the sort of way you fact check them is typically through the fee structure that they have on their investments. In almost all cases, when you're getting investments, for the vast majority of individuals, it's going to be specifically mutual funds. Mutual funds are effectively an investment that's made up of a lot of smaller different investments, and it allows you to get diversification, a lot of different investment types, a lot of different companies in a very low-cost way. And it's very powerful and very beneficial for middle income people who don't, say, have $1 million to invest. So it's a very ideal investment for that kind of individual, for the average Joe, and it's what most individuals are going to be investing primarily in. And so there are a couple of fees associated with mutual funds. The first is an MER. a management expense ratio. And what that is because this is a mutual fund is an investment made up of smaller investments, there's someone who manages those smaller investments. And they charge a fee to manage those investments. That's perfectly reasonable. The question is, how much are they charging? And sort of that's where you want to really sort of break down, is this person have my best interests at heart? So with an MER, they're typically going to range anywhere between 0.3% and 3%. And breaking that down, anything above 3% is ridiculously high for a management expense ratio. Run away. Do not deal with that investment advisor. Anything between 2 and 3% is very high, and I would probably say walk away from that individual as well, because typically the higher the MER, the more kickbacks or commission that the advisor is going to get. So you want to be very wary of anyone who's recommending a very high MER for whatever reason. Anything between 1 to 2 can be reasonable. Anything above sort of a 1.5 is a little bit high, can be reasonable depending on where you're investing. Between 1 and 1.5 is reasonable. Anything below 1 is good. That's great. This person's probably giving you at least fairly good advice, at least has your interests at heart. Maybe not the best advice. It's hard to check that without being knowledgeable about investing, but at least they're probably not getting major commission kickbacks for charging you high fees. The second thing you want to look out for are load fees. Load fees are an incredibly ridiculous thing that exists. Effectively, what a load fee is you have to pay someone to take your money so that they can invest it and make money off of that. If that statement seems ridiculous, it's because it is ridiculous. The only reason load fees actually exist is because people realistically aren't aware of them. They don't really know what's going on with their investments, and they should not exist. And if your advisor ever recommends anything with a load fee, a deferred load fee, anything with a load fee, no, go away. It should be a blanket cut. Say no to load fees. No load fee on all of your investments. They're an absolutely ridiculous thing. As I mentioned, the only reason they exist is because people aren't aware of what they're paying, why they're paying that, and when you are, they're just a ridiculous concept. And sort of a third final thing that isn't necessarily a fee, it also isn't necessarily a blanket sort of, I'm going to walk away from you as an investment advisor. You should be prioritizing index funds in your mutual funds. The reason for that is they typically will have lower MERs. They're not actively managed. They're mutual funds that are designed to, say, mirror a market, a stock market, or some other form of market, and they're effectively designed just to follow that. And so they're cheaper when it comes to fee structures. Typically, over the long term, there's no difference in return between them and managed funds, and so you should be prioritizing them, but they're not necessarily, if your advisor isn't have access to them or isn't pushing them, it's not the end of the world. MER should be your primary concern for deciding on investments, and then load fees should be a blanket sort of cutoff, no load fees whatsoever. And the last one I sort of wanted to touch on is a mortgage advisor. This one is fairly simple. Realistically, when you're going to a mortgage broker or advisor, you should know what payment you can handle beforehand, before you go meet your individual. So you should have already done an analysis of your budget, the amount of debt you have, and figured out how much you can comfortably pay each month. And that is the best way to protect yourself with that. Fairly simple. Go through that process, see what would be manageable on a budget. Those are sort of the three areas. So insurance should map to a specific risk and only cover you for that as long as you have that risk. When it comes to investments, lower fees, certain fees you should avoid completely, no load fees, and prioritize index funds, but that's not necessarily a hard cutoff for investment advice. And then mortgage brokers, know your payment before you go meet your advisor. As I mentioned before, the absolute best way to protect yourself is become more knowledgeable about personal finance, learn about things, and that is how you protect yourself. Finances Done Right tools and information has a lot of stuff that can help you there and provide sort of additional stuff that you can fact check on and make sure that you have a quality base to do that fact checking. That's available to you. You can go visit at financesdoneright.com. And as always, if you like the video, please like, share, and subscribe. It helps me grow as a channel. And have a great day.